Well, it's been a marathon. It's been 12 hours. We started early doors this morning in Asia. The first interview, actually, with the head of Vitol in Asia, Kieran Gallagher, first interview. The bookend of that now, 12 hours later, is Anas Al-Hajji, managing partner of Energy Outlook Advisors in Texas, the world's probably greatest analyst, most respected, that's for sure. Anas, thank you for joining us and being our punctuation point.
Thank you. Thank you very much.
So, I mean, after the drama of so many conversations today and the drama that we are all facing every day when we wake up and read our headlines, if indeed we're able to sleep, but what's very similar between 2025 and the beginning of 2026 is lots of dramatic headlines, a very boring, sober oil price that just wants to snooze on the couch. Is that going to continue to be the dominant narrative of 2026 as well?
Sean, we do have a serious problem how people look at oil prices. People think if we have a political event, then oil prices should go up. They think if OPEC or OPEC Plus or the group of eight cut production, then oil prices should go up. That is not the case. The case is just like you are looking at a cup that is half empty or half full. Which one you want to focus on? And the way we should look at it, if you want to understand what's going on in the market, is that let's go back to April of 2025. Most analysts around the world, and some of them basically been on your show several times, they've been predicting oil prices to decline to 30s and 40s. And they did not decline to the 30s and 40s. So we should really compare prices to that, not to that we have an event and they
well, we
up.
had an average Brent price in 2025 at $69 a barrel. I mean, most producers would bite your hand off for that number if you gave it to them every year.
Well, not in April. As you know, when the group of eight decided to unwind the voluntary cuts, everything changed. So the whatever been predicted in December of 2024 basically changed in April 2025. So the whole idea here is we should look at the events relative to the forecast, not to the actual price that day.
Well, if we take the idea that in some ways, this is a market that, I mean, from a price point of view, events happen, they may or may not impact the price, and clearly geopolitics seems to be having a minimum impact on price. But what is happening is supply, and we're talking about suppliers of oil competing for a relatively small growing marginal demand growth market. And again, that was the case last year. It looks like it could be the case again this year. And I wanted to get your thoughts on where suppliers are at. The idea that we've seen OPEC Plus increase through the second half of last year. Now they're pausing that increase. And now we have the events in Venezuela, which looks like this will at least start the journey of Venezuela's oil supply recovery. Where does OPEC Plus, do you think, stand today in terms of competing for a flat demand growth market? How does it navigate that in 2026?
Let me clarify a few points here that are very important. If you go back to the International Energy Agency forecast, or most of the investment banks forecast, the market should be in complete crash today. In a complete crash. Because they were talking about...
We certainly had this sort of surplus crying wolf a few times.
Correct. So what happened is they were predicting that oil demand will grow only by 700,000. You look at the group of eight increases, it's in millions. So where did that oil go? That means their forecasts were completely wrong. That means
well, nobody expected to see China build inventories at 1 million barrels a day in 2025. That seemed to be the shock surprise for everyone. Without that, you may have got that that price crash?
Again, we have many misconceptions. I mean, when you look at the oil market and you look at the various analysts, we have a whole spectrum of forecasts from the far left to the far right. Why all this confusion? In fact, why at the end of the year, while all the forecasts should converge, we still have differences in oil demand, which is supposed to be one number, one fact for everyone. And so we do have a serious problem with that. Here is why we need to pay attention to this. We have the spot market and we have the contract market. And when we talk about the surplus, we do have to define what surplus is. And here on your show, I'm going to challenge everyone to define surplus.
Surplus as surplus? In more supply, oil supply than demand, than consumption.
Well, we need to define it. So that's the issue. There is a big problem defining it, because the way that the media and the IEA and the big banks are talking about it, that I'm going to have a flood of oil that's going to crash the market and oil prices will decline. But once you look at the market and you try to really define the surplus accurately, you end up with a completely different picture. Because a surplus, by definition, you have buyers who have oil, they want to sell it, there are no buyers, then the sellers will store that oil until their inventories are full, and then their pipelines will back up, and then they will be forced to cut. But if you are talking about contracts, the Saudis, for example, do not sell in the spot market. They sell on contract basis. So as long as the Chinese will keep asking them for oil, the Saudis will supply. So the assumption that the Chinese are building those inventories, and if they did not, then that will be a surplus, is absolutely not correct. Because one of the mistakes I made last year, when I said that oil price, it was even on your show, similar to this one, when I said that prices will be range bound in the 70s. And that prediction was wrong, because now we found out that the average price was $69. Yeah, close to 70, but I'm not going to give any excuse to that. I was wrong on the forecast. It wasn't in the 70s. The first half was in the 70s. The second half was in the 60s, and we ended up in the low 60s. So what did I miss? Is exactly this point that we are discussing right now.
And when
we do the analysis, we focused on growth on global oil demand. And when the group of 8 decided to unwind the production, there were 2 conditions to unwind. The first condition is a major decline in global oil inventories, and that happened in the first quarter of 2025. So the first condition is met. The second condition was a strong growth in demand. For me, I was looking at strong growth in global oil demand, and it wasn't there. But because of sanctions and because of the Chinese strategic decisions, the demand for many members of the group of 8 was very strong, and that's what I missed. So for them, they saw the decline in inventories and they saw strong demand, while I was still fixated with the idea of a global growth, not the demand for the group of 8 or some of them.
And how do you see that continuing into, we saw the end of the year, China, fourth quarter, they continued to buy a lot of additional oil that they weren't consuming, which one presumes they've put into inventory. Again, on the average for the year, it worked out about 1 million barrels a day by secondary source analysis of inventory build, stock build in China. Does that continue through 2026 with the geopolitical backdrop?
Here is the situation. As of last week, according to Kepler, inventories in China continue to rise, and as of last week, they are at record high. So they continue to build. And when you look at the global inventories, basically, we have to make sure that we understand the situation. First of all, I'm sorry, I have kind of allergies in my eyes, so I'm bothering me.
Please.
The first thing is, those who are talking about the surplus, they say, look, U.S. oil production continue to increase. At least we have data until October, continue to increase, and U.S. oil production at record high, and that is bearish. If you look at this statement alone, yes, it is correct, but we don't look at that statement, we look at the whole picture. At the same time, the U.S. government locked more oil in the strategic petroleum reserves than the increase in U.S. oil production. So is that oil that is locked in the strategic petroleum reserves a surplus, or is it a demand? So the impact of the U.S. basically is almost zero on the oil market if you look at the whole picture.
I think what you're saying is ultimately that these are in essence kind of new definitions where the market is changing. I mean, China has never built this.
No, not new definitions at all. It just analysts are not distinguishing between supply and demand.
Well, China's never built this level of inventory before. From
So
the point
I
of
will
view,
talk about that in a minute because it's related to the point about the United States.
I mean, if we had the United States building 1 million barrels of oil inventory a day, oil prices would crash. I mean, that would be, if you had Cushing coming out with 4 weeks of oil inventory building at that kind of level in America, that would be seen as very bearish. In China, it's seen as somewhat bullish.
Let me explain that. Okay. For the last 3 years, we've seen a change in China's behavior, and it is a strategic change. For some reason, we can speculate, of course, but for some reason, they wanted to reduce seaborne energy imports, energy that include oil, LNG, and coal. And they adopted 3 strategies. The first one is increasing domestic energy production at any price. And we've seen them investing heavily offshore oil and gas, and they were extremely successful in natural gas. So their production natural gas increased substantially.
Big drop in LNG imports last year, 15%. China LNG imports down.
Yes, and they stopped importing from the United States completely last February. And at the same time, as you know, for years, they've been investing heavily, and they were the largest investor in solar and wind. The investment and the expansion in solar and wind has nothing to do with the climate change, has nothing to do with the environment. These are byproducts of this strategy. The strategy here is very simple. I want to beef up my domestic energy sources. Solar and wind are domestic sources, and therefore they have a strategic value.
Domestic everywhere if you want to put the money into it.
Correct.
Even in Texas, the biggest state in America for renewables.
Yes. So what happened here is they wanted to beef up their energy security and therefore their national security by increasing domestic production. The second strategy is to build inventories of everything in life that can be stored, period. And that include oil, natural gas, coal, and all the minerals, metals, whatever food, whatever thing, etc. And they were oil storage at a record high, gas storage at record high, coal storage at record high, and everything else, even iron ore and everything else. And then they have a switch in strategy. That is the result of the attack on Iran, by the way. And I'll explain that in a minute, where they wanted to import more via pipelines, more gas via pipelines from Russia, and more coal via rail from Mongolia. Because they don't, in this case, they can ensure that the United States and the West have no control of the flow of energy. Because the main lesson that we learned, and I used to teach in my energy economics courses, that whoever controls the flow of energy to any country can determine the destiny of that country. And what we saw basically is China importing LNG from Russia via the northern route, because the United States have no control in that area. And of course, the EU does not have control either. So China's behavior is very clear. But when we talk about the storage, we have to be very careful. in the United States, we have a very clear difference between the strategic petroleum reserves and the commercial reserves. The strategic petroleum reserves are owned by the US government. They are paid by the American taxpayer, and it's the US government that can make a decision to release or not to release. While the commercial basically is owned by the companies, and it worked according to the market. In China, we do have strategic petroleum reserves, but when it comes to the commercial, mostly they are owned by government-owned companies. And therefore, there is kind of no line in between the strategic reserves and the commercial reserves. And therefore, when we look at China, even when you look at the teapot refiners, who can really object to government orders?
Well, they exist under very tight quotas of what they can,
Correct.
amounts
So
that
what
they can
happened here
import and
is
refine.
all China's inventories, in a sense, are strategic inventories. And therefore, this build that we've been seeing, in fact, I did put this for those who follow me on Twitter or subscribe to our Substacks. I did put this morning a chart. They can look at it where it shows the Kepler data for the storage. So the whole idea here is most of the decision to buy this oil was strategic, although it's not classified as strategic. The other related issue is we have to remember that this storage came in from very cheap oil. That is the Russian oil, the Iranian oil, and the Venezuelan oil.
And that's obviously going to be even cheaper now. At least the Iranian and Russian is. The Venezuelan is a sort of exhibit A, perhaps, that China can get cut off from its supply. I wanted to look forward into 2026 as the year in which OPEC Plus is reconfiguring its baselines for new quotas into 2027. I'm wondering, from your perspective, does OPEC Plus maintain its current strategy right through the year, no change, increase, or cuts? And how well are they prepared for what seems to be a turbulent change with new baselines? Your vision for OPEC Plus year ahead.
I will go back to this point in a second. I just want to point out a few important points.
Please.
China knew about Trump's actions in Venezuela ahead of time, and they reacted accordingly ahead of time. So officially, they stopped importing from Venezuela weeks ago, probably like seven weeks almost right now. So officially, they are not importing from Venezuela. Yes, there are some unknown destination ships, but we know they are going to go to China anyway. And then what did the China do? Switch to Western Canada, which is the same quality crude. And you can see, if you plot the chart, you can see the substitution in this case. So what I'm trying to say here is,
signed a big agreement with Canada.
A couple of things here I would like to emphasize. What China is doing right now with the substitution is exactly what the US did with the substitution between Canada and Venezuela. Exactly the same. And Venezuela is, at this stage today, is completely irrelevant to the United States. The United States is importing only 170,000 barrels a day, while importing more than 4 million from Canada. So if we halt Venezuelan exports completely, the impact on the global market is very limited. The impact on the United States is very limited. And
what about this?
China is very limited.
This announced. Let's go into Venezuela as you're discussing it. There's so many things to sort of dig into, but let's start with the point that Trump announced yesterday that Venezuela were going to give the U.S. essentially 50 million barrels of oil that's backed up in the storage tanks. For what purpose, it seems a little uncertain, but ultimately, regardless of who's paying who, what, where, it's still 50 million barrels of oil coming into the U.S. market. Is that relevant, not relevant?
Now, let's focus on the numbers. There is no 50 million barrels in storage in Venezuela. I counted every ship last night. Okay. And according to Kepler, there are 22 million barrels on in-ground storage. The increase is only 7 or 8, and that's really what can be used. The others basically will remain in storage. And if you look at all the ships that are still stranded, if you use this term, we have only about 11 to 12 million barrels in all those ships. Some of it is owned by others, not by Venezuela. So there is no 50 million. There is not
So
even 30
if
million.
Donald Trump sends
Okay.
20 tankers to pick up oil in Venezuela, they'll have nothing
Well,
to pick up.
they will be in big trouble. I will tell you why. Because tanker rates are already high, and we don't have enough tankers for that. So I think this is a general statement. We are still waiting for the details, and details here matter. The final point I would like to mention on this is the following. What is the role of Venezuela in this case? If you look at the global exports of crude right now, the amount of heavy crude in it is relatively small. Is only about 9% of global traded oil is heavy crude. So it's very small. But once you look at the share of Venezuela in it, it's about 19 to 20%.
20%
So the impact
of the 9 million.
Of the 9%, of 9% of
Well,
the
it's
traded.
about 9 million or 9%.
No. It's about 33. This is the traded oil, not the demand.
Oh, sorry. Okay.
Traded crude.
Oh, traded. Okay.
So it's about 3.8 million. That's it.
Okay.
But
right.
the main point here is the impact of Venezuela is on price differentials more than the overall price. So the impact is coming from crude quality, not quantity. And that's the point. The other point I would like to explain is what Trump is talking about and why this idea that he wants to control the 300 billion barrels of Venezuela, that's absolutely not correct. All he is doing basically is the following, that the nationalization of the assets of the American companies happened without compensation. And the American companies went to arbitration and they won every case. And Venezuela still owes those companies billions and billions of dollars.
I think
And
Conoco is owed 10 billion.
It's about 12, I think.
12 billion.
Yes. Okay. So the American companies basically are telling Trump, I need my money. Exxon needs its money. So Trump is telling Venezuela, look, I need my money. Give me my money. But the problem is you are bankrupt. You cannot pay me. You have nothing but oil. And therefore, I'm going to take that oil and sell it and get my money back. That's really what he's talking about. Here is the irony. He blocked Venezuelan oil from being sold to China. And now he's going to take it and sell it to China.
And the American government blocked American companies from going into Venezuela for the last few years. Chevron had to beg every time to be able to go in.
Yes.
There wasn't Venezuela blocking American companies. It was America blocking American companies going in. How big a change is this? I mean, if one takes a big picture, big sort of 10,000-foot view, obviously there's a lot going on in Venezuela, in the whole sort of China in South America. I mean, how big an oil story is this? Does Venezuela, not that it's really been an active member of OPEC for recent years, but does it end up withdrawing from OPEC? Is this a new Western Hemisphere oil block emerging, or is just noise headlines? What's your thoughts?
No, it's noise, and I'm going to tell you why. To increase oil production by 1 million barrels a day, assuming all stars align and everything is there, it will increase production by 1 million barrels a day. It will take 3 years. In 3 years, global oil demand will grow by 3 to 4 million barrels a day, and decline rates will eat about 10 to 12 million barrels. So we are short already 15 to 16 million barrels by that time. So there is no need to talk about a surplus or exiting OPEC or anything else. But here is the problem that analysts missed. We need about $20 billion right now, as we speak, to go back to Venezuela to increase production. If this 20 billion is going to be a transfer from somewhere else, or it's an additional money or additional investment. Our companies are going to have an additional investment in Venezuela, or they are going to divert investment from shale, from Brazil, from Nigeria, from Guyana, and bring it to Venezuela. If they are going to divert it like they've done in the past, then it's not a net increase.
Well, if you had $20 billion, would you not put it into the Permian Basin? I mean, it's right next door. There's no political issues. There's no title deed. I don't know. Am I doing a deal with a drug trafficker? Let me just go into West Texas and drill another hole.
I mean, what you are talking about basically is exactly the point that I'm making, that those who are talking about a flood of market exiting OPEC, etc., is a complete nonsense.
So let's
Because
look
that
at
money
OPEC.
is going to be
We're
mostly
going
a
to be
transfer.
running out of time here a bit. How big a challenging year is this for OPEC Plus, with the context of trying to agree new baselines? Obviously, many countries can't increase; they don't have money, etc. How big a challenging year is this for OPEC Plus?
I'm going to look at one side. I'm trying to kind of focus on points that other analysts did not talk about.
Okay.
Our view basically is that oil prices will be range bound in the 60s this year, because if Brent prices go above 70, China is going to use some of that inventory to quell prices and prevent prices from increasing. And there is no bearish case like some people are talking about. So I don't think that prices will go to the 40s or low 50s as some people are talking about. Again, I'm talking about Brent here. But there are two cases. If we end up with those two cases, these are really bullish, even if the Chinese basically use their inventories. The first one is a trade deal, a comprehensive trade deal with China. And
well, Trump and
is
Xi
going to be
Jinping
bullish
are
for
due
everyone.
to meet in the spring.
Okay. And the other one that no one is paying attention to is this massive energy demand by AI. And the problem we have right now here is what the AI companies right now are worried about, and the CEOs are talking about. They are afraid of a major backlash from the public and politicians if we end up with power shortages. So to avoid that backlash, how you are going to solve it? Because we cannot build enough power plants to meet this massive increase in AI. So what I'm predicting here is we might end up in some areas and some quarters with companies being forced to use private generation. And private generation uses diesel and LPG. And that's an extra demand for oil that is no one counting in their outlooks.
That might
so
be.
If this happen, then there are no problems with OPEC plans basically bringing back whatever left from the unwinding of the production. But if you really look at the actual numbers, what we are going to find out is that many countries within the group already maxed out. So only very few countries can increase their production. And what people are not paying attention
without
to is
spending a lot of money, obviously. I mean,
oh, absolutely. But as they increase their production, the problem that people are not paying attention to is that the amount needed, the amount that will be taken off for maintenance will be higher. So yes, there will be an increase, but when they go for maintenance, all of a sudden you are going to see that major drop, because
you think there will be harmony? There will be harmony within OPEC Plus, as they get to these baselines over the coming year. Is there any jeopardy to OPEC Plus, OPEC holding together?
It's very hard to tell for several reasons. But looking at the history of OPEC, not OPEC Plus, looking at the history of OPEC, we learned something very important for what's going on right now. That we ended up with a war between Iraq and Iran, and both of them are founders of OPEC. And none of them left, and the organization did not collapse. Then Iraq invaded Kuwait, and we have the Gulf War. Both of them are founding members. They did not collapse. Then we have all kind of dispute with Libya and others, etc. It did not collapse. We have the dispute between Iran and other Gulf states. It did not collapse. Now we see this dispute between the UAE and Saudi Arabia and Yemen, and we saw the meeting just couple of days ago for the group of 8. Both of them were there. Everything's normal. So when it comes to OPEC, it's a completely kind of different organization from what we could think about people getting mad at each other and taking it at OPEC and therefore leaving. The only example over 50, 60 years, well, it's been right now 65 years, that Qatar left. That's the only example basically that happened. And beside that, nothing, I mean, Angola left, but Angola was not supposed to be there in the first place. But the idea here...
Go ahead.
The idea here is very hard to tell about the harmony, given the history of OPEC on one side, and on the other, we have the Ukraine war, and once it's end, what the impact is going to be, and now what the behavior is going to be, etc. While we have other things going on, including
if one takes the 2026 outlook, and obviously there's very big momentum and big effort by the Trump administration, and obviously Europe is very engaged now as well to resolve the Russian war in Ukraine. Regardless of whether they get there, and let's assume that in 2026 they'll get to some kind of ceasefire, if nothing else, does that change the dimensions of the oil market in 2026? I mean, the Russians oil flow has pretty much gone uninterrupted.
Yes, it will change it the following way. I mentioned earlier that China built its inventories from cheap oil because of the sanctions.
Yes, they did.
So if sanctions are eased, then prices for India and China are going to go up. At the same time, some people are saying, well, Russia is going to increase production if the war ends. Or at least its supply, its exports are going to increase. That's absolutely not correct, because Russia cannot increase production while it has to go and fix its refineries, and therefore the utilization is going to increase, and the use of crude within Russia is going to increase, and therefore the supply of crude from Russia, if the war ends, is going to decline.
Some people are interpreting, I mean, the different tangents for the situation in Venezuela. The indication now appears to be that Trump is going to encourage oil supply and production and growth in Venezuela. Iran got 1.5 million barrels a day on average to the markets, international markets last year. Can it expect to do the same this coming year?
Yes, I mean, the Iranians and the Chinese have perfected this game. I think it's even more than 1.5. I think it's 1.8. They perfected
months
this game.
But on the average, at least, it seems it's around 1.5, 1.6.
That's possible.
Yeah.
So the idea is they perfected this game, and the only way, I don't know how much time we have left, but the whole idea here is we have all those rumors about the new attack on Iran between the US and Israel. We won't know what's going on, but the unintended consequences on energy markets basically are not being counted. And I am surprised until now that the thought leaders in the energy world have not even written about this. This is becoming a serious issue in our organization, basically, when it comes to unintended consequences.
The serious issue being another war with Iran that could be quite consequential for the oil markets?
Yes. And here's why. Because Israel attacked Iran, okay, that's not a big deal. And then Trump attacked Iran. That's a completely different game and a massive deal. All of a sudden, we've seen the media in the West, especially in the United States, talking about Iran closing the Hormuz Strait. And I am completely convinced that those stories are paid and promoted. And China, the Chinese leadership, understood that perfectly. That, yes, the Hormuz Strait could be blocked one day, but not by Iran, by someone else.
Yeah.
And that will block the LNG flow from Qatar and the UAE to China, and therefore, the message at that time was, do not sign those contracts with Qatar and the UAE. Come to me and sign them here so I can supply you with LNG. It's an LNG war. So what did China do? It revived a dead pipeline project with Russia for billions and billions of dollars. And they signed a deal basically, and they are depending more on Russia. And the energy cooperation between China and Russia increased substantially after the U.S. attack on Iran. So
And
another
will
attack
continue
on
to
Iran
do
right
so.
now. Yes. So another attack on Iran, basically, it will enhance the cooperation between those two countries, and it will change the trade direction. And I think what we are going to see is China is going to help Russia build more LNG carriers that are nuclear powered with icebreakers, so they can use more in the northern route where there is no existence to the United States there. So the
We haven't even
unintended
mentioned
consequences.
Greenland.
Correct. But the whole idea here is there are unintended consequences to the energy markets over the long run that people are not paying attention to.
So are we really, I mean, just to wrap up with this sort of big idea for 2020, are we starting 2026 with this US-China Cold War now clearly out front and center, and that's sort of that's been filtering in the background, but ultimately with this sort of Monroe doctrine, the Donroe doctrine, Venezuela, get China out of Latin America initiative, that all of these pieces are kind of part of this bigger game. I mean, you've said to me before that the American engagement in the Red Sea was all about warning China's access to Europe.
It is absolutely correct. In fact, I can make the whole case that everything we've seen in Venezuela and Panama Canal, etc., is related to this. And probably this is part of the objective of the recent national security strategy that's been released about a month ago, because the main idea is that we want to dominate the world through two things: energy abundance and AI. Here's the problem: no AI without energy. And therefore, it boils down to energy supplies. And if there is a war or competition with China or others on AI, and the future is about AI, and that's where the dominance is, the objective of the United States is to be ahead of China by several years. And the only way it can slow it down is through the energy supplies. But China knows that. That's why they are building those massive inventories, and they are spending their money on increasing energy consumption within China and depending on Russia, etc. So you can see how this competition is being played out, and it is about this abundance of resources. So if Trump is after oil in Venezuela, beside paying the debt, it's really about control, which is the same old ideas from 50, 60, 70 years ago, when they wanted to control the Gulf, the Hormuz Strait, Bab el-Mandeb, Suez Canal, etc. It's almost the same old stuff being repeated.
And it's the same old stuff when it comes to sort of mercantile power politics as well, isn't it? I mean, you have both the raw material war. I mean, the big thing that played out in 2025, the rare earths versus the tariffs, the energy. Now, if you're deficient in rare earths, you go after the energy, I suppose. And this will make, I think, the biggest meeting of this year. As you mentioned, a possible trade deal, China-US, but the summits this year between Trump and Xi Jinping are going to be massive in their, I mean, will Trump trade Taiwan for Latin America? I mean, these are some big ideas. Anas Hajji, managing partner of Energy
May
Outlook.
I just mention a very quick comment here?
Yes.
I know we are out of time.
Yeah.
But if you look at the globalization movement in the 90s, there were two items, basically, that were important, basically, is globalizing the American financial system and the copyrights. So we talk about globalization. Now with anti-globalization, they are killing everything except those two. So those two are still there. And through the globalization of the financial system, they can do all the sanctions and all the controls on insurance of shipping and all that stuff.
Control the dollar. Well, it's certainly going to be fascinating as a lot of these very big ideas come to the surface in 2026, a year in which, I mean, we've come through a period in which a lot of things were in the background, a lot of things that are they're not necessarily new, but obviously the CIA overthrew presidents in the past. And has documented and released classified documents on them 50 years later, Allende in Chile and so on. But here we're doing it all in public now. There's no hiding behind CIA classified documents anymore. Let's see what else will happen in public in the coming year that will be consequential for all of us, but for the energy markets, which is our kind of bread and butter. Anas Al-Hajji, Managing Partner, Energy Outlook Advisors, the world's #1 energy analyst. Thank you for closing out our marathon day at the Global Energy Outlook Forum. We look forward to seeing you soon again out here in the Middle East.